Does anyone else feel like they're doing everything they were told to do and still somehow falling behind? You work, you save a little, you invest a little, and yet every year it feels like the finish line moves farther away. Rent goes up, groceries cost more, houses feel like they're priced for a different species, and you're stuck running on this invisible treadmill, putting in effort, burning energy, but not actually getting ahead. I've got bad news. It's not your fault. The old rules are dead. The advice that worked in 2015 or even 2019 doesn't survive in today's economy. Inflation quietly rewrote the math. The goalposts have moved, and most people are still playing the old game. That's why so many smart, hardworking people feel behind despite doing the right things. They're not bad with money, they're just following the wrong order. Here's the first uncomfortable truth we need to deal with. Income is not wealth. Let me say that again, because this myth is expensive. Income is not wealth. You can make good money and still be financially fragile. In fact, millions of people are. Data consistently shows that a majority of high earners live paycheck to paycheck. That means if the income stops, the whole system collapses. One layoff, one medical issue, one bad quarter, and suddenly all that success turns into panic. This is why flexing income numbers is meaningless. Wealth is what you own that keeps working when you don't. And if your money doesn't have a job, you don't have wealth. You have stress disguised as stability. Most people don't fail because they don't invest. They fail because they invest out of order. They jump straight to stocks, crypto, or real estate because that's the exciting part. It feels productive. It feels grown up. But excitement doesn't pay bills during a downturn. Before you think about growing money, you have to make sure money can't destroy you. That's where the correct order starts. And yes, it's boring. The first real investment isn't stocks. It's safety. Cash, an emergency fund, 3 to 6 months of expenses sitting somewhere boring and accessible, not because cash makes you rich, but because it keeps you alive in the game. Without it, every market dip becomes an emergency. Every unexpected expense forces you to sell investments at the worst possible time. Cash buys you time, and time is leverage. It's the difference between being strategic and being reactive. Once that foundation is in place, the next step is dealing with the silent wealth killer, high-interest debt. Credit cards charging 18, 22, sometimes 25% interest are not just debt, they're financial gravity. You can't out-invest them. You can't hustle your way around them. Every dollar you owe at those rates is working against you harder than your investments are working for you. People love to talk about average market returns, but they ignore guaranteed losses. Paying off high-interest debt is one of the highest returns you'll ever get because it's risk-free. It doesn't show up in a portfolio screenshot, but it changes your financial physics. Money finally stops leaking out the bottom of the bucket. Only after you've handled survival and eliminated toxic debt does investing actually start to make sense. This is where people think they need to be clever, but clever is overrated. The real advantage is using the system correctly. Tax-advantaged accounts are the closest thing to legal cheat codes. A 401k match is free money. That's not an opinion, that's math. A Roth IRA lets your investments grow without future taxes, which is huge over decades. The key here isn't picking the perfect stock, it's owning broad, low-cost index funds consistently. You don't need to beat the market, you just need to stop fighting it. Timing the market is gambling. Time in the market is strategy. Boring consistency beats emotional brilliance almost every time. This is also where patience starts paying you back, even though it doesn't feel like it at first. Compounding doesn't look impressive early on. In the beginning, it feels slow, almost insulting. You put money in month after month, and the balance barely moves. That's why people quit. They assume something isn't working when it's actually just warming up. Compounding is exponential, not linear. Most of the growth happens later, after years of repetition. The people who win aren't the smartest or the most informed. They're the ones who stayed invested long enough for time to do the heavy lifting. Consistency matters more than intensity. You don't need perfect years. You just need enough decent ones stacked together without panicking. Now, here's a part most finance advice skips, even though it matters more than any stock tip early on. Your biggest investment at this stage isn't the market, it's yourself. Skills that increase your income by 20 or 30% beat almost any realistic investment return, especially in the early years. Learning how to negotiate your salary, improving a high-value skill, switching to a better paying role, or building a side income that doesn't destroy your health creates more capital to invest. And here's the key part most people mess up. You don't inflate your lifestyle just because your income goes up. If your expenses rise at the same speed as your income, nothing changes. That's how people make more money and still feel broke. Income isn't wealth, but income properly deployed becomes powerful. As income grows and investments compound, something subtle but important happens. Stress starts to come down. Decisions stop feeling urgent. You're no longer reacting to every headline or market swing. This is when people realize that financial progress isn't just about numbers, it's about optionality, the ability to say no, the ability to wait, the ability to walk away from bad situations. That's real wealth, and it only shows up when the order is right. Once you've built income, invested consistently, and protected your downside, that's when advanced investing finally makes sense. Real estate, businesses, private deals, even speculative assets. Notice the pattern here. These come last, not first. At this stage, risk is calculated, not desperate. You're not gambling rent money. You're allocating excess capital. That distinction is everything. Losses are uncomfortable, but they're not catastrophic. Wealthy people don't take more risk than everyone else. They take risk after they've removed the possibility of ruin. This is also where mindset quietly separates people. Beginners ask, how fast can I get rich? Professionals ask, how do I avoid blowing this up? That shift changes everything. The goal isn't a lucky win or a viral success story. The goal is staying in the game long enough for probability to work in your favor. Most people underestimate how damaging one bad decision can be, and how powerful a series of boring, correct decisions can become over time. Wealth usually looks unimpressive while it's being built, and obvious only in hindsight. Here's the part that might sting a little. The economy is harder now. That's real. Housing is expensive, inflation is stubborn, job security isn't what it used to be. Pretending otherwise doesn't help, but clarity beats optimism. If you understand the environment you're in and adjust the order accordingly, you don't need perfect timing or insider knowledge. You need structure. The right structure turns effort into progress. The wrong structure turns effort into exhaustion. So if you feel behind, don't assume you failed. Ask whether you were given outdated instructions. Many people were. They followed advice designed for a cheaper world with more stability. That doesn't mean they're bad with money. It means the playbook changed. Once you fix the order, protect yourself first, eliminate guaranteed losses, invest efficiently, grow income intentionally, and only then take smart risks, the whole game changes. Progress stops feeling fragile, setbacks stop feeling fatal, and for the first time it feels like your money is actually moving you forward instead of running in place. Wealth isn't built by one decision, one investment, or one lucky year. It's built by sequencing decisions correctly over a long period of time, especially when the environment is hostile. The system doesn't reward how hard you try or how stressed you are. It rewards how well you structure your money. And now you know the structure.